All right. Good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative. I want to thank you for taking some time out of your afternoon today for a conversation on a very relevant topic right now. And lucky to have a couple really exemplary discussion leaders from our lender member network to help us navigate through it. So this is part of our TMC Connect network, where we do a lot of stuff just like this, real-time discussions, conversations around the topics that are most pertinent and top of mind to our members. We also have a lot of that going on our electronic networking forum at ask-tmc. Also have similar mediums on LinkedIn and Facebook, dedicated groups. All of them are closed off to just our lender members. And then, of course, TMC Benchmark, our data benchmarking tool for our members that is part of membership that members use to, see how they stack up on a monthly basis against our whole network and their peer group within it. So as noted previously, lucky to have a couple of excellent discussion leaders with me this afternoon, two individuals that have led these sessions for us before. I'll start with Wesley Costello, the SVP of Quality Management and Collateral Risk from Annie Mac Home Mortgage. Wes, thanks for joining us.
Hello, Rich. Good afternoon. It's nice to be here. I didn't know it was going to be a video call, though, and so I'm a little bit disappointed about that. I woke up this morning and looked in the mirror and thought, oh my gosh, it's Conan O'Brien. But I get to cut my hair in 14 days, so I'm pretty excited about that coming up.
Yeah, the video. I like seeing everybody's home offices and everything they got going on. I guess some people will still have a lot of remote employees, but I'm almost kind of sad about people going back to the office. And then, of course, Allison Johnston, not only the president of Success Mortgage Partners, but on our lender board of directors. Allison has been leading sessions for us for pretty much my entire 5 years here. So, Allison, thanks for joining us.
Thanks so much. I'm actually excited to get back into the office. Being home with 5 kids, 2 dogs, and a cat, I just need a partridge in a pear tree for it to be complete. So hopefully in the next couple weeks, I'll be able to get my hair done since our shelter and stay is now over and be able to get back into the office.
Yeah, I forgot about the 8 kids /pets you have. That's a lot to go on there. Yeah.
That's a lot.
I remember when my kids were young and I only had 2, I was hitting the road to go drive to the office at like 5 a.m. when they were under 4.
Yeah.
All right. And the topic for this actually, it was on my mind because we've had a lot of members really just inquiring and networking with one another around QC in general. I think a lot of it pre-corona was related to getting signed up with Fannie and Freddie, becoming direct seller servicers. Most lenders that go down that path don't have the proper QC protocol and processes in place that Fannie and Freddie are looking for. At least that's been our experience. So, and then of course, everything that's it became more important because of forbearance and overlays, and Allison was actually part of a call that we did on new company policies you've actually established or plan to establish. And Allison on that call was speaking about some of the different things they've implemented on the QC side. Soon as the call was over, I was like, Allison, we got to do a call on QC if you wouldn't mind jumping on another one. So that's what leads us here. So before we get into some of the specific changes that Allison and Wes have led at Success Mortgage Partners and Annie Mac, just wanted to talk QC more broadly in general to get things started here. In general, just curious, Allison, I'll start with you. If the pandemic has just changed how you view quality control, numbers and calls we've done, they're like the unsung heroes, our QC people, or people that outsource, having a great experience with their outsourced provider, saying that they felt it's been a real difference maker for them these last few months. So just curious how your view on QC in general maybe has changed these last few months.
We have a third party that we use. We feel that it's gone very well. Most importantly, and this is even before the pandemic, is just communication, making sure people are reading the reports, seeing what is coming on there to make the necessary changes. But even with everything that happened COVID-19, with all the overlays that have been, put on place that we've been doing, that we've been going over, I think it's really important just to keep the lines of communication open. We've increased our pre-fund significantly when all this COVID-19 hit. In fact, one of the other things is just making sure that we verify employment 24 hours prior to closing. Now, we do that just to make sure that, the borrowers are still working, but we will keep that even after COVID-19 and people go back to work for sure, because we've caught borrowers not employed. I mean, I would say probably even today, it's probably 3 loans a week that we've taken application on, we've gotten a clear to close, verification was done 10 days prior, we're calling the day before, and a co-borrower might not be working and the income doesn't work. So some of these things that we've made changes on, we're going to continue to keep them in place even after states are all reopened and people are back to work.
That's awesome. Thanks for sharing that, Allison. Wes, this is your world, risk management, quality. Curious to get your perspective on how these last few months may have changed your view.
Rich, I would not say that COVID has it's caused us to change what we do, but I wouldn't say that it's been such a paradigm shift that it's caused us to change the way we view QC institutionally. Number one, like Allison said, we immediately moved to institute a re-verification of employment 24 hours prior to closing. And it's something that we had discussed doing previously, but we knew, with what was coming, unfortunately, with unemployment in the marketplace, and we discussed that in a TMC call, at the beginning of this, how crucial that was going to be. So that's something that we set up a new group of employees that can do that in rapid fashion. It changed a little bit of the way that our processors document the employment to make sure that we absolutely have the right information at our fingertips immediately prior to closing, so we're not unnecessarily delaying something. And it is something that we will consider keeping for a longer run as well. We definitely made more changes in the pre-close QC space. And what we found is that we made sure that our quality control data was part of the conversation with credit policy immediately in terms of what guideline changes are we going to institute, what processes, what overlays are we going to have. So our data on our deficiencies, as well as our data on factors that cause our delinquencies, were very helpful in that regard. I think we were pleased that the time that we took for the last couple of years to try to identify what causes delinquencies, that we had that data on hand, because it was very helpful in, where are we going to make some changes to our credit policy. And then in the pre-close QC, if there was a change in how we view QC institutionally, it was that having a very nimble pre-close QC is as important as we thought it ever was, so that we could deploy targeted reviews for our COVID changes that came from the agencies and any overlays that we might have, because a lot of people in QC know when you have a change in your guidelines, it's you're likely to have deficiencies related to those changes, because Susan might not have been there that day. She might have been on vacation when that was changed. So you make sure that you review those aspects of the loan file. So we've deployed a targeted, we actually call it our COVID pre-close audit, where we have 23 different questions that we look at. So this is what's changed. And we're able to deploy that to about a little over 15% to 20% of our loan files in a component review. And then we're doing a smaller sample that's actually a full file review.
That's great, Wes. Something I want to follow up on there, and I want to get Allison's thoughts after yours here, Wes. So, when I was last a lender about a little over 5 years ago, I mean, the typical rate, I think we pre-funding QC files, and loan, but it was at that point it was an event before closing that at least the loan originator and the realtor felt like could delay closing. You mentioned the importance of being nimble in pre-funding QC. You also mentioned, I think, between 15 and 20% check rate, and a subset of that would be even a more thorough review. So if you could follow up, did you change those percentages at all these last few months, number one? And part two of the question, what do you think the biggest keys are to having a really nimble pre-funding QC process?
So we did change that. So we increased our component pre-close QC review percentage, where we're usually around 10%. We nearly doubled that. We really found out of what we believe to be nearly necessity due to all the changes. And what we utilize to an attempt to stay as nimble as we can in the pre-close QC is our reporting. So we report a lot of it in real time using Tableau that can go to our operations managers and then down to operations staff. And we do that by, trending defect by responsible party, so that every month we're doing at least one different targeted pre-close QC review than we were doing the month before. Some months we're doing just one, some months we're doing two. So we might say, hey, we had a little uptick in asset deficiencies, both in our post-close and our pre-close. We're going to look at more files just for the assets. So we might have assets, income, and employment as a combined component review, or more recently, as we do for the strictly COVID-related requirements. And I think that in addition, the reporting that we look at is the primary driver of that. And the second would be having your QC management plugged in to credit policy so that they're not surprised by changes from credit policy. And then taking that further, having all of your auditors, whether it's internal QC that you're using like we are, or external, have access to credit policy in reviewing recent guideline changes. At our organization, we typically in the past had a credit policy meeting that goes out to underwriters, other parties, QC auditors on a monthly basis. And recently in this environment, it's been on no less than a weekly basis. And a couple of occasions, twice a week in the early going of COVID here. And what goes on in those calls, and I'm sure it's this way at other organizations, is it's about an hour reviewing all the policy changes. And every person, and it's a large group on the call, can pose questions. Sometimes if they're detailed scenario questions, they don't get into that meeting, but then there's a fax that comes out of that meeting. Okay, this question was asked. Every single one is answered. So it gives folks in operations as well as QC the opportunity to ask questions about credit policy changes. It leads to a better understanding. And then sometimes it also leads to credit policy saying, oh, well, maybe we didn't think this guideline out enough. It needs to be hashed out a little bit better. So it's actually able to be used by the operation and QC.
That's excellent. That's a lot of good stuff there. Allison, I'd pose you the same question. Have you changed any of your review percentages, and any things at SMP you guys believe are really critical to having a very, very nimble pre-funding QC process in place?
So we increased it about 15%. We were 10%, so we were doing about a quarter of our loans. How we make a change within the organization is we were doing a lot of town hall meetings twice a week, because the most important thing is it's great that we're making the change in operations, but we need to understand from the sales perspective, because usually they get some scenarios that are a little off the cuff trying to figure it out. Self-employed is a tricky one, right? We're asking for a letter of explanations of how COVID-19 has really affected their business. So you can get all sorts of letters with that. One of the things that we do is when we make a change, which we've made several changes with the COVID-19, is we do automated conditions for the underwriters that'll automatically fire on certain files that they have to sign off on as a reminder for them. But one of the things that we've done too is, and this was standard practice for us, our team leads in our department are responsible to really audit about 15% of their team's work. So some of that QC process, now we do a pre-fund and we do a post-close, this is in addition to it, but then we have them target self-employed income, making sure that the letter's there. And if the underwriter does not sign off on the condition, since it's an auto fire, they can't get a clear to close. So we've done some things in the system really to make sure that we don't miss certain things, because there was a lot of things that we changed. Warehouse lines changed for credit score requirements. Investors changed on certain programs. We pulled the DPA programs, which were just starting to roll back out. But there was quite a few different things that had changed as far as the pre-fund, making sure that we're taking notes on the meetings, sending it out so the sales team and the ops team are on the same page, doing the town halls. But we also have our executive team and our managers get together before we make a policy change. Credit risk does a great job. You know, they're sometimes a little more conservative because you still have to generate loans. So you have to find a happy middle to make sure the loan's solid, the loan's saleable, but also we don't have issue on the sales side. So I would say with the pre-fund, you know, we're doing 25%. It is in real time as well. If there's something that's happened on a file that seems to be a repeated miss, we will build something in the system as a reminder, and then we will have those team leads focus. But every manager is responsible at our company to do a 15-minute powwow in the morning, 5 minutes motivation, 5 minutes of training, and 5 minutes the goal. So that 5 minutes of training has really been focused around the changes that we did with the COVID-19. And then notes are taken and they're distributed to everybody in that department. So if somebody's not there for one day, they have the notes, and then every manager can see every other department's notes on what's been covered. I think for us, the biggest change has been really understanding the self-employed, reading the letters over, and then other things that we've done is we shoot a lot of videos for our sales team. So we will use examples, not necessarily by loan officer or borrower, but here's a letter that we've received that is not okay. So the loan officer knows if they said their business has been affected, they're not getting in the income, you know, that's really not going to work for self-employed. So we're trying to educate people as well of what's acceptable and what's not. But it was really a crazy time for those 8 weeks when everything had been, you know, going through influx and changing, just making sure that we're doing what we're supposed to get the best quality loan put together.
Thanks, Allison. That's excellent. I remember, it seems like not that long ago, like literally make copies of files and shipping them off to our post-close QC investor. Obviously, technology has positively impacted the mortgage industry in a lot of ways. I'm interested to hear from the two of you. And Wes, I'll start with you. How technology has changed quality control, either internal or outsourced, and how you feel like it's poised to continue to change QC. We you know, all these next level technologies that are really on the horizon, if it's, you know, more expanded document recognition and artificial intelligence, what could look like a few years from now?
Great question, Rich. And it's something that we are somewhat enamored with, but we haven't gone too far with it. So really in the pre-close space, I think it could look completely different than it does currently for us. So rather than having a moment in time, because it's not required by agencies to be the way that we have it now. As a moment in time, we have an auditor take the file and look through the file. I really believe that a model that there's automation throughout operation, and then that automation can be used by an auditor to validate, yes, this has been taken care of. The CD matches the 1003 and it matches the AUS. Almost ashamed to say that right now, we do stare and compare for those types of things. It could also be utilized in the post-close QC space where we use a questionnaire-based audit. We do have it, a software provider that's connected to our loan origination system, so the data can flow into and out of that. That is probably the biggest technology change that we've had, and we're about 18 months into that. It's given us some efficiencies so that we can go through the audits quicker, but it's probably more, we're saving 10 to 12% of time on the audit, as opposed to if we can have indexing. Indexing itself will help our auditors because every document will be where it's supposed to be. And then if we have data scraping from that indexing, we'll have less errors, not only a quicker audit, but less errors because the data will be taken directly from the document. And then in our questionnaire, if a questionnaire right now is 65 questions, what we'd like to do is have the stare and compare eliminated. So of those 65 questions, after the bot gets done, it might say, okay, there's now 25 questions left. 40 questions have been cleared and 5 have been looked at, but it should have sort of a second level review from a QC auditor. And I believe that through those methods, we can double the speed of QC audits and improve loan quality at the same time.
Thanks, Wes. Yeah, I've had a lot of people much smarter than me tell me that really, on the way here, it poised to impact quality control as much as anything. And what you just said would seem to back that up. So, Allison, QC technology from manual copying of files to where we're at now to where we're going. Your thoughts?
We love technology. We have a handful of bots that are already built. On the QC side, really just the bundling part where the bot can go in and do the bundling of the file to upload it to our QC provider. That is something that we're trying to test. We do have a couple bots that are in process right now that have really helped. We have an ICD one that scrubs the ICD, can go out automatically, but with the new technology, like we're just scraping the surface. You can pretty much, any process that's done over and over again, you can build a bot for. You can build a bot to read a homeowner's insurance policy. And one thing I will say about the bots that we have in place right now, now granted we have dashboards in case there's a sale or something like that, but they don't make mistakes. I mean, you program it and it will do the same thing over and over again, and that does help with quality. So if you have a particular situation where you're struggling with, I don't know, I'm just trying to think, say self-employed income, you could literally build a bot that will take those tax returns, upload them to whatever provider, LoanBeam, whoever it might be, and they'll automatically kick the income back, and it's a step that the underwriter doesn't have to do. Or you could build a bot to read fraud guard. I mean, there's so many different things that you could build bots to do, but I think just scraping the surface for technology, I think that it's going to make the process a lot easier. I mean, when I started, we were paper files and it had a pink copy, a white copy, and a yellow copy that you had to keep for the file. But now with all the different technologies, I'm excited. I think it'll allow the teams that you have now to focus on more high-level stuff instead of necessarily, order outs or sending an ICD out. If you can have a bot do those minor things, and they can focus on more high-level things. So I'm excited for what technology will bring.
Awesome. Thanks, Allison. And I forgot to mention it. I think it goes without saying, just looking at the list of attendees, a lot of people that have been on a lot of our calls. Obviously, any questions, comments, please feel free to drop it in the chat or the Q&A, and we will distribute a copy of this recording and the deck to everybody in the morning. So speaking of the deck that I've ignored for the first 28 minutes, that could be a new record. We are going to get to that now, because we did get some great suggestions from our discussion leaders on some specific things this session, I guess. So the first slide that we're looking at right now, Allison, this is a lot of stuff really related to the coronavirus and the pandemic. So I'd ask you really to highlight anything of note here. You mentioned a couple of things you're keeping in place. Just ask you to react to what everybody's looking at on this slide here.
All right, so borrowers' forbearance attestations, that's signed in the closing package. One thing when COVID-19 came out, I think there was a lot of confusion on if people could file for forbearance, what that would look like. So one thing that we did was a little bit different is we shot a video for all of our clients and just really explained the forbearance process. What does it mean to you as a borrower, and what is the impact? Now, the FHFA has come out with more clarification, but in the very beginning, the borrowers didn't know how that would affect them. So we shot a lot of videos that went out to the clients. The other thing that we did is we sent out videos to people in the process if their income had changed. Because that was one thing we wanted to know. Like, if they're in the process and they have income that's changing, then maybe that file shouldn't go to underwriting. One thing that we put on there is we were verifying employment prior to locking. Well, you're verifying it a couple times in the process, but you really want, with everything going on in the secondary marketing, we really wanted to make sure what we were locking were loans that were going to close so that we wouldn't have exposure for that. And the other thing is really looking at your business model. With things changing and borrowers possibly going into forbearance, if you are selling that loan to an investor, then the possibility of a repurchase coming back if that borrower were to file forbearance within 15 days of that loan being purchased. For us personally, we had to look at our business model. We did have our Fannie ticket. We did service a small amount of loans, but for us, from a risk standpoint, we increased the amount of loans that we were servicing, and every loan that we book onto our servicing portfolio, we do a pre-fund on. So those are some changes that we made. I think our business model changed a little bit more with our servicing portfolio. And then just really educating our clients too that, hey, guess what? We're going to verify your employment like a gazillion times before you close. So please tell your loan officer if you're not working, because we're going to find out. And then really why they're signing the attestations, and just making sure that the borrowers had a real clear understanding, because it was chaotic for them too. The mortgage process is anyway for them, and they're very anxious, but we just gave layers of it with all the changes that we did. So those were some things that we did operationally, but if I can stress anything, communication is the key. You have to make sure your borrowers know why you're doing it, the loan officers know why you're doing it, and your ops team. So when a realtor asks them or a borrower asks them, they're well equipped to answer those questions.
Thanks, Allison. Wes, some specific things you did at Annie Mac that you felt were impactful these last few months, and maybe some things that you implemented these last few months that you're going to continue to do based on better results.
I think the one of the bigger things, Rich, is getting very, very serious about the verifications of employment, making sure that it's the right people doing that verification of employment at the right time immediately before closing. I would say that the communication to the borrower about the impact of these COVID changes is very important. But I love the idea of a video. We didn't do anything that great. That's a great idea, Allison. We had previously, prior to COVID, had a bar attestation that we did amend for COVID. And we also had borrower communication. So, part of our automated communication process with our borrowers already had integrated into it the importance of notifying us if something changed related to employment or income. And that was done both through email and a phone call to the borrower through the process. We also have an initial disclosure that relays the importance of the income and the employment and the changes that would go through that in the process. So those are probably the biggest things, Rich. And I would say lastly, looking at the delinquency data, what is your delinquency data telling you? If you're not a large servicing organization, you're going to have some limited delinquency data, but the FHA neighborhood watch information can be very, very insightful. You have 2 years there of performance data, no matter whom you've sold the mortgage to. And if you can somehow get, that large bank of loans and the performance of those loans to be reported together with everything that you have in your loan origination system, how many reserves the borrower had, of course, what the credit score was, if there was a gift, what the LTV was, what the increase in percentage in housing payment is. When times like this come and you might be increasing the amount of loans that you're servicing, and you're going to have a situation where you have an increasing amount of borrowers going into forbearance, either because they just decide that they want to, or for many people, they legitimately have a need for forbearance. You can make smarter decisions in credit policy with what your guidelines are and what your allocation of those loans will be.
Thanks, Wes. One huge trend we've seen with our members just over the course of the last few years is more outsourcing. I think, outsourcing firms have gotten more competent. It's obviously a good way to even out the cyclical nature of the mortgage industry. Allison, I know at Success Mortgage Partners, you guys outsource a lot of the aspects of your quality control process. Would welcome your thoughts on, I think, some of the keys to setting up and managing your QC outsourcing relationship correctly.
Lots of communication. I mean, first you have to have a point person who's going to be responsible for that relationship. With us, it's our QC manager. She's responsible for that. But anytime you outsource anything, it's going to take time and energy, communication, and make sure that it's done right. We do outsource our QC. We found a vendor that works well for us. It wasn't our first vendor that we used. The first one, we fell short on both sides. So we learned from the second one. But most importantly is communication, and then making sure they understand your business model and how you do business. So if there's anything that I can say for that is just, you got to spend the time on the front end, and then it'll be a better result on the back end. If you try to hurry through it without those communication and the weekly calls, I mean, we started with, twice a week calls, then every week. And then it got better to, we had a comfort level with them on the results that we were getting, but we're still responsible to QC the QCer. So we still have to audit a percentage of what our outsourcing company does, which we do, just to make sure we're not seeing any trends. And I think if anything, the most important thing that you want to find out is, are you having an issue? Do you have a trend? And are you fixing it? And I think those are some of the most important things that you have to take into consideration and implement.
Thanks, Allison. We've got about 7-8 minutes left. Wes, you've mentioned a few different times not only the importance of reporting, but really using your QC data in an actionable way, involving your quality control people in credit policy. and taking those reports that are produced and really understanding what they're saying and adjusting your behaviors and processes accordingly. Would love the importance of reporting as part of the QC process and some of the best practices at AnnieMac that you guys utilize in that arena.
Yeah, Rich. So I would say that you have to have your data ready to be reported. So it wasn't that long ago where we did our QC all through Excel spreadsheets, and it made wanting to do data wanting to do meaningful reporting impossible. Somebody could mess up the data. You just didn't have the data integrity. So you need to get serious about where your data is stored, and there's going to be a cost there, whether it's something that you build yourself, whether you make a choice to outsource the QC process, which costs money, or if you use a vendor for software to audit your loan files in, and then you have all that data readily available to be reported. So that would really be the first step. And the other is, with your discretionary QC, whether it be pre-close or post-close, it's going to be so much more meaningful if it truly is driven by the loan files that have likely to have the highest incident of deficiencies. And you're going to need reporting to be able to tell that. You could just say, oh, we're going to go with the highest DTIs or the highest LTVs and the lowest FICO scores and keep it static at that. But there's really more in there if you look at the data, and that's what it will tell you. Responsible party reporting, we found, is an area that has really paid off for us. It might seem obvious, but when you bring new underwriters onto your organization, there's high deficiency rates, not always, but sometimes with those new underwriters. It's a difficult process to transition to a new organization for even the best underwriters. And for people that aren't the best underwriters, they can really struggle. So to sort of support your underwriting management, something that you can do is give real-time reporting from loan number one on, if you have a new class of underwriters that come in, you can have a report that goes to real time to your underwriting managers, not just showing the amount of deficiencies and of course the severity, but where those deficiencies are. You can have an underwriter that is very good and has made a smooth transition to the organization, but perhaps the method of overtime income calculation that your organization has adopted is different from where they come. You'll be able to see that trend. And if you wait too long to see that responsible party reporting for new employees, it can lead to some legacy issues down the line that 3 years from now, you can be indemnifying a loan or repurchasing a loan from an underwriter that you had 3 years ago. So what we didn't do in the past that we do now is see the quality of new operations members right away when they come into an organization. And that's been something that's been helpful to us. I think lastly in that area of reporting is if quality is going to be one of the most important things in your organization, the performance reviews and compensation changes have to have quality be a meaningful factor in those discussions and in compensation changes. So in quarterly reviews, in annual reviews, as someone who leads QC at your organization, you want to make the point very forcefully, backed by very good data and reporting, that we need to use this data to review with our operations people.
Excellent points. Thank you, Wes. And this was great. This was a great conversation. I really appreciate both you guys being a part of it. Learned a lot. That's one of the things I love most about all these TMC Connect calls we've been doing these last few months. Like, I'm learning a lot, which, and our staff is learning a lot, which in theory makes us better, advocates for our members, and is creating a stronger organization. So really appreciate you guys taking the time out to talk with us about some of the things you've done these last few months, and disclosing quality control, pre-funding quality control in general. So before I depart, I want to thank you both for joining us, and offer you one last chance. Any final words of wisdom on the topic of QC for our members? Allison, I'll start with you.
Wes, you had a great point. We do the same thing to make sure if they're new underwriters, new processors, we get those files in, because one thing that we have is a bad underwriter is a gift that keeps giving for years after. They're indems, repurchases, so it's really important that you check the quality of your new people and communicate when there's an issue to make the change.
Awesome. Wes, any final words of wisdom for the TMC members?
The only other thing I think of, Rich, is for a company that does not outsource their QC, that does it within the organization. One thing that we're looking to do now is to have just a little outsource piece. So some of the things that, as we've gotten busy, production's increased, our auditors are reviewing more loans, is to have a contract person who does some of the things on the periphery, such as re-verifications. You can even outsource if you're not outsourcing a little bit. So that's something that we're looking at right now.
Excellent. Allison, Wes, thanks again. To all the attendees, thank you for taking the time out this afternoon. We'll follow up and get you over a copy of this recording, as well as the presentation, and appreciate your membership, and hope to see you on another Zoom soon here. So have a great afternoon, everyone. Take care.
Thank you.
Bye, guys.
Bye.